Okay, good morning, everyone. I'm Dean Martin. I'm a partner here at Kushner LeGrays. On behalf of all of my partners, I'd like to welcome our clients and our friends of the firm to this morning's discussion as we review some new opportunities to small businesses that are now available as a result of the passage of the Consolidated Appropriations Act. The act itself is massive. It's over 2,000 pages long. There's a lot to digest. We're going to talk about only a couple small pieces today, but they're the pieces that we believe are most applicable to small business owners. In particular, we're going to talk about the Paycheck Protection Program, which now has 2 rounds. And then we're also going to talk about employee retention credits, which are available for calendar years 2020 and 2021. They're a little bit different in each year, as you'll see as we go through the materials. But the benefits out there are very substantial. And our goal today is to make you aware of the programs and to give you some best practices, recommendations on how to go about coordinating your efforts in an integrated approach to get the maximum benefit that is available for your business. We're not intending in this seminar to give you every detail about the program. That would probably be at least a 2-hour discussion. So we're trying to hit the high points this morning and keep it at about 90 minutes and then leave about 10 minutes after the presentation for your questions. You have 2 options for submitting a question. You can either use the chat feature in Microsoft Teams. If for some reason that's not working for you, though, please email info@kl-cpa.com. Those will get forwarded to me, and in the Q&A seminar, I will pull them up and go through all the questions that are submitted. If for some reason we're not able to get to your question this morning, I promise you that I will respond to you to give you the answer that you're looking for. So with that being said, let's go ahead and dive into the materials. The first thing we want to talk about are changes to the original Paycheck Protection Program. And in particular, we're going to talk about some improved tax consequences, as well as some borrower-friendly options on your forgiveness applications. And then finally, some more good news for those of you that received an emergency disaster loan advance. So on the tax front for PPP Round 1, we finally have a legislative solution to a problem that many small business owners had, and that is to be able to fully deduct your PPP loan expenses and have the loan forgiveness as non-taxable, which is what Congress originally intended. So now in the Appropriations Act, it's very clear that your loan will be fully non-taxable. You will get to deduct your expenses, and your tax consequences are going to be similar to what the original intent of the bill is. On the loan forgiveness front, for those borrowers who have round 1 loans of under $150,000, you're now going to be able to submit a 1-page loan forgiveness application. No other documentation is going to be required, and in that 1-page application, you're going to estimate how you spent the loan proceeds, as far as what you spent on payroll, what you spent on the other forgivable expenses, and pretty much sign saying that you complied with the program. So that should lessen your burden as far as what you need to do to get forgiveness on your round 1 loan. Keep in mind, though, that you are certifying that you complied with the program and that you should still keep all of your records in case the SBA ever audits or requests those in the future. But you don't have to submit everything up front to get forgiveness if you have a loan that's under $150,000. For those of you who have loans of over $150,000, we still have some benefits for you out there on the loan forgiveness. And that's going to come in the form of increased expenses that you're able to count towards your loan forgiveness application. And we broke these down into two categories. The payroll costs, which you can now count, are insurance premiums paid for group policies on life, disability, dental, and vision. And then on the non-payroll expenses, this is going to be particularly helpful for those in the restaurant industry or hospitality industry, because some of those businesses had trouble spending their PPP-1 loans in the allotted time just due to limitations on their operations, not in their control. So you have some help here. I want to highlight certainly the first three categories. I'll go over some examples. The last one, property damage due to vandalism or looting that occurred in public disturbances in 2020. It's fairly self-explanatory. I just want to mention there it can't be covered by insurance. But as far as the examples on the other ones, let's look at a few. The first one to your left are for business software expenses. You can now count these as forgivable expenditures of your round one loans. And it's specifically going to be software that helps you facilitate your business operations kind of remotely or in a cloud. But a lot of businesses have them. They're going to be Skype or Zoom licenses, any software to help you track your payroll, HR, inventory, accounting functions, and things like that. On the supplier costs, you have to distinguish between a perishable item or a non-perishable. If the item is non-perishable, then it would have to be purchased pursuant to a purchase order that existed prior to your loan forgiveness period. But if the item is a perishable good that's essential to your business, you can count all those purchases that occurred during your loan forgiveness period. Restaurants should benefit from that greatly because they will have a lot of perishable goods purchased. And then finally, the last category here are worker protection expenditures, and they can cover both your workers and your customers. You know, any kind of expenditure that you had to facilitate the adaptation of your business, you know, due to regulations by the CDC or a government entity, you know, to help with social distancing. There are some examples. For a restaurant, particularly, you may have expanded outdoor seating or an adaptation to a drive-through to allow you to take more traffic. Things like that you can count here as protection expenditures, or any kind of the physical barriers that we all now see, sneeze guards, things of that nature, or PPE. All those can count towards your loan forgiveness. So hopefully what this is going to do is allow those businesses that were impacted the most to gain additional expenditures that they can use on their PPP round one loan forgiveness. May also give you some added flexibility when we get around to identifying payroll costs for the retention credit, and we'll get to that in a little bit. Also on PPP round one, we have a second chance here for some businesses who qualified but didn't apply, or who received loans of a lesser amount than what they were able to receive. If you did qualify but did not apply, and you still meet the necessity test of having the loan, you're needing the loan to facilitate your operations, you now have until March 31st to apply, you know, subject to availability of the funds. On the additional loans, you have to meet one of the circumstances identified here. At least these are the circumstances that the SBA has issued guidance on so far. I want to draw your attention to the note below first. the additional loan increase requests on round one do not apply to a mathematical error. You really have to fall into one of these categories of a partnership that didn't include partner compensation in its round one loan, or a seasonal employer or farmer who now has some added benefits or options to file for increased loans. I'm not going to get into all these scenarios again, just because we're trying to hit the high points here, but it's something to consider. And then finally on round one, for those of you who received emergency disaster loans and the advances associated with them, these are $1,000 per employee, subject to a $10,000 max. If you applied for SBA disaster loan, you had the option to request this loan advance, which originally your PPP round one loan forgiveness was going to be reduced by this idle advance. So it wasn't necessarily a grant if you received a round one loan, because ultimately your loan forgiveness was going to get reduced by it. In the Appropriations Act, now they're no longer going to reduce round one loan forgiveness by these idle loans. And then as an added kicker, your loan advances are also going to be excluded from taxable income. So good benefits there. If you already applied for and received your round one forgiveness, then chances are it did get reduced by this idle advance. If that is the case, the SBA is going to automatically contact your lender, and your lender is going to get remitted those proceeds, and they should in turn reduce your loan amount by that idle advance. So for a lot of you, that's going to make your PPP round one loan totally forgiven. So that's a quick snapshot of the changes to round one. Now we want to get into the employer retention credits. When we talked about these stimulus programs earlier this year, for a lot of you, we didn't get into the retention credits. And that's because initially it was an either-or scenario. You could either apply for PPP or you could claim retention credits. PPP was the larger benefit, so almost all small businesses opted for that option. But the benefit of the retention credits is still substantial. As you can see, it's a maximum credit of $5,000 per employee if you qualify and are able to get the maximum. That credit would come in the form of a refund on your payroll tax returns that you file quarterly, with the one caveat being that while you can participate in both programs, you can't use the same wages to both request PPP loan forgiveness and claim the retention credit. So before we get into coordinating between the two, first we need to test to see if your business is eligible for retention credits in 2020. And what you're looking for when you run this test is one of two triggers that are outlined here. First, you're either looking for a decline in gross receipts or revenues that's at least 50% as compared to the same quarter in 2019. And you're looking at that same quarter in 2020. So Q2 to Q2, Q3 to Q3 in 2020 as compared to 2019. That's a pretty significant test to meet. Some businesses I've seen do meet that, but it would be a significant decline. If you don't have that, you do have another chance to qualify, and that would be if your business operations were either partially or fully suspended due to a government order related to COVID-19. We'll give you some examples of that in a little bit. But first, on the gross receipts decline, if you do look at your quarterly revenues and you do identify a quarter where you did have a decline of greater than 50%, then your period where you can claim these credits is going to start with the first day of that quarter, and it's going to run until the last day of a subsequent quarter where you were able to restore your revenues to 80% or more of prior year. For both of these scenarios, receipts decline or suspension, you can only count wages paid after March 13th because those are identified as actual, revenues impacted by COVID. So here's an example of this 50% gross receipts test. You would compare your revenues for each quarter of 2020 to 19. In this specific example, we had a decline of greater than 50% in Q2. And by Q3, we were able to restore our revenues to at least 80% of the prior year. So in this example, our relevant period would be the first day of Q1, and it would run until the last day of Q3. So this is what you would have to look at if you're testing for that gross receipts decline. This taxpayer would be able to claim the credits on their Q2 and Q3 payroll tax returns. And if those returns are already filed, then you can go ahead and file an amendment to request the refund. The definition of gross revenues for purposes of this test are pretty much going to be all of your receipts, dividends, rents, other income. You can reduce those, or you should reduce those, by any returns or allowances, but not by any cost of goods sold. And that's how the revenue test is going to work. As far as the partial or full suspension of business operations, unlike the revenue decline test, this is more of a facts and circumstances review. So what you're looking for here is a government order that you had to comply with that limited more than a nominal portion of your business operations. And I would draw your attention to more than nominal here versus a 50% decline on the revenue side. You definitely have a lot more leeway in establishing a more than nominal effect as opposed to impacting half of your revenues. So the best way to illustrate this, since it's facts and circumstances, I'm giving you a few examples here. These are straight from the IRS frequently asked questions, where they have identified instances where the suspension would be in effect. The first two are on a restaurant. I'm not going to read the cases word for word, but essentially in all instances, whether it's affecting, restaurant to where they're only allowed to use takeout, or maybe they could do takeout and outdoor seating, or in an instance where maybe their capacity was limited, it's 5% of capacity, or where they had to space out their tables. In all of those instances, if that order has more than a nominal effect on their operations, it could qualify as a suspension. The third example, which we see a lot with our clients in the medical field, would be a medical practice, that maybe is considered essential in some respects and non-essential in others. Here we have a hospital, that has an emergency room that, of course, is an essential activity that remained open, but maybe they had to cancel their elective procedures for a period of time. If those elective procedures represent more than a nominal portion of that hospital's business, then they have a partial suspension of their business operations and should be eligible to claim the retention credit during that time period. The final example here just shows how the time period would work for a suspension. The earliest date you could claim the wages is March 13th, and then you'd be eligible to claim the credit for as long as that order was in place. Once the order is lifted, then you no longer meet the suspension of business criteria. A few other observations from the frequently asked questions. You should consider your ability to obtain supplies if you have a critical supplier. that made you unable to obtain goods, that could qualify you. If you had to reduce your hours, maybe close at a certain time where you would normally be open, that could be a criteria for a suspension. However, in order that requires your customers to stay at home, or if they choose to stay at home, that would not meet the definition of a full or partial suspension. You'd have to meet the revenue test instead. And then you should also consider your ability of your employees to telework if they're able to do that and you're able to continue your operations in that respect. So once you've evaluated the two triggers, and if you do see, okay, one of them does apply to me, the next thing you should consider are your full-time equivalents and your full-time equivalents in 2019. If you have under 100 full-time equivalents in 2019, then you can pretty much count all of your wages paid during the relevant time period where you met one of those two criteria. If you had over 100 full-time equivalents in 2019, then for this credit, you can only count the wages or health plan expenses paid for an employee that did not perform services. So for the small businesses here, they're going to be able to treat a lot of their wages during that, or all of their wages, as eligible for the credit, even if the employee did perform these services. You get a little bit of relief here on this rule in the 2021 retention credits, and we'll touch on that in a minute or later in the presentation. So once we've done that, we've identified the time period that we were eligible. We've looked at our FTEs, saw which wages we could count, then we can actually calculate the credit. And your retention credit in 2020 is going to be 50% of the first $10,000 of wages or health plan expenses that you paid to an employee during the period where you're eligible. With the caveats being that you cannot claim a retention credit on any wages you count in your PPP Round 1 loan forgiveness, and you also cannot claim retention credits and the COVID paid leave credits on the same wages as well. And then in 2020, you also can't claim retention credits on wage increases. So if you increase someone's pay during that time period, you can only claim the retention credits on their wages before the increase. This is another item that you get a little bit of relief in 2021 on the retention credits. So just to give you an example of how big of an impact this could be, we'll consider a business with 30 employees with average monthly payroll of $100,000. That business probably would have received a PPP Round 1 loan of about $250,000. Now with retention credits also into play, there's an additional potential benefit out there of $150,000. That's assuming they got the max for each employee. Maybe they were only shut down for 3 weeks. It'd be hard for them to get the maximum, but there's still a significant benefit out there. If we prorated the payroll over 3 weeks, we're still looking at a $30,000 retention credit on top of the PPP loan. But as far as one of the items I mentioned previously, that you can't double dip on the loan forgiveness and the retention credit, the IRS and the SBA are tasked to consult with each other, and then the IRS is going to issue regulations on exactly how the retention credit is going to work as far as a business's ability to make elections or really pick and choose which wages it can count on which program. What we're hoping here is for maximum flexibility to really allow businesses to get 100% of the benefits in each. As far as the best practices, what do we have to tell you today? Again, this is subject to future guidance that is coming, and we're going to monitor it. But first, what we would recommend is to test your applicability for the retention credit in year 2020. And then test it as if the PPP Round 1 loan does not exist. First, look at your revenues, test for the 50% decline, and then consider whether or not you have a suspension due to a government order. If one or both of those apply, then go ahead and define the period that you're eligible and calculate the maximum retention credit that you're entitled to. If you can get that maximum credit within periods that do not fall within your PPP loan forgiveness, then that's great. You can go ahead and apply now. But if in order to get your maximum credit, you really need wages that fall into that PPP loan forgiveness window, that's where you want to wait for the regulations and make sure that you're coordinating your approach before you file for a retention credit or before you file for PPP round one loan forgiveness. I have looked at instances where a business was able to get the maximum credit they're entitled to for the year on retention credits all in the fourth quarter. And in those instances, it makes sense to go ahead and you can submit your round one loan because you're still going to max out on your retention credits in periods where the PPP doesn't even apply. But those are rare. I think most businesses are going to fall into an overlap period where you really want more guidance before you go ahead and apply for either benefit. And that's what we're talking about here. So that's your benefits that already occurred in year 2020 that you're now eligible for. As we go into 2021, we're going to talk about the second version of both of these programs. And we're going to start with the PPP round two. So here's a comparison of the round two versus round one. As far as the maximum benefit for a lot of businesses, the loan for PPP2 will be the same as their first round loan because you have the option here to get 2.5 months of payroll either using 2019 or 2020 as your period to calculate. Most businesses that I see had higher payroll in 19, so that's the larger loan, and that is the same computation as PPP1. The one added benefit for restaurants or hospitality businesses in round two is they can qualify for 3.5 months of payroll instead of 2.5 months. The employee limits for PPP2 are more strict. You have to have under 300 employees in almost all circumstances. A little bit of a added benefit for restaurant hospitality. They can still look at the number of employees they have at each location in regards to meeting that test rather than globally. The eligibility trigger for PPP2. First off, you must have received the round one loan and must have spent or will have spent all of your round one loan on eligible costs prior to receiving a round two loan. And then finally, you need to have a revenue decrease of at least 25% in a quarter in 2020 as compared to the same quarter in 2019. That test is going to look very similar to the retention credit test for 2020, except that instead of a 50% decline, you're looking for a 25% decline. And if you do have that 25% decline, regardless of which quarter it's in, that makes you eligible for the round two loan. And you only need 1 quarter. The time frame, that's one thing that's going to be similar between both programs. If you get a PPP2 loan, you still have up to 24 weeks or as little as 8 weeks to use that loan and count it towards loan forgiveness, and the same eligible expenses apply. Here's your gross receipts definition for PPP2. It's going to look very similar to the retention credit definition of revenues. Still reduce your revenues by returns and allowances. Count all of your investment income, and you would not reduce revenues for any subcontractor costs or cost of goods sold. And in both instances, retention credits and PPP2, as far as your method of accounting, it's going to be your method that you report taxes on. So if you're a cash basis taxpayer, you're looking at cash receipts. If you're an accrual basis taxpayer, you look at your revenues on the accrual basis of accounting. On your round 2 loans, as far as the documentation that's required, if you are using 2019 and you're applying with the same lender, you're not required to submit any documentation of your monthly payroll because it's going to be the exact same as your round 1 loan. That's in the regulations. I am hearing from a couple clients now that their lender maybe is switching a loan platform, and they're asking that this documentation be submitted anyway. So if that's the case, hopefully you do have that handy, and you could just pretty much give them the same information you gave them with your round 1 loan. If your round 2 loan is under $150,000, then you're not going to be required up front to submit documentation of the revenue decline. However, you will be required to submit it upon your request for forgiveness, or if you don't ask for forgiveness, upon the SBA's request. So best to actually gather this documentation up front in order to make sure that your certification is accurate and you are eligible for this second round of the program. And then finally, if your loan amount is over $150,000 in PPP2, you must submit quarterly profit and loss statements and/or bank statements that substantiate your revenue decrease in 1 quarter 2020 as compared to 2019. We want to call out the certifications and call your attention to that you're going to have to submit with your PPP round 2 application. Among other things, you're going to have to certify first that you've used the full amount of your PPP1 loan on eligible expenses. That doesn't mean that you use the full amount within the 24-week period. If it took you a bit longer, which we do have some restaurants who were not able to use the proceeds within 24 weeks. But if it took you longer than that, that's okay. You might not be able to get forgiveness on all of your round 1 loan, but as long as you are still spending the entirety of the proceeds on payroll, on perishable goods, etc., before you receive your round 2 loan, you still meet that certification. And then also, this is a biggie, is you are required to certify that the current economic uncertainty makes your loan request necessary to support your business operations. And that's going to be the current uncertainty. So that would be the uncertainty as it exists today, which may be different than the uncertainty that existed earlier this year. Wanted to call your attention to that. If you have any question as to whether or not you do meet this certification, it might be a good idea to consult with your attorney just to make sure, upfront that if you're ever questioned on it, that you believe you have a defendable position. The SBA's current position right now is that it will not question a borrower's good faith of the loan necessity certification for any borrowers with PPP1 loans of less than $2 million. That's the current position. Whether or not they issue any guidance that changes that for round 2, I can't guarantee that won't happen, but that's the position right now. Keep in mind that this does not exempt a borrower of a loan from under $2 million from making the certification. You're still required to make the certification. Just in an effort to conserve resources right now, the SBA is really just going to focus on the loans of over $2 million. A few other observations on PPP2 loans. Your deadline here again is March 31. There's about $284 billion appropriated to this program, which is a little bit less than the original appropriation on round 1. And it's subject to availability of the funds. So if you do qualify, you certainly want to be kind of at the front of that line. You don't want to be waiting on Congress to appropriate more money, because there's no guarantee that they will. Your maximum loan on a PPP2 is $2 million. So if you qualified for over $2 million in round one, you're going to be limited to $2 million on a round two loan if you otherwise qualify. Again, the loan forgiveness terms mirror the round one in terms of the length and the type of expenses you can count. And then also, and this really applies to both PPP and retention credits, the affiliation rules apply when you're looking for a revenue decrease, or if you're computing full-time equivalent employees or just number of employees. If you have multiple businesses with common ownership, you should aggregate those together for purposes of testing for the revenue decline, or looking at the number of employees that you have. So there's a quick synopsis of PPP round two. So now we want to get into their employee retention credits as they exist for 2021. These is going to be for the first 2 quarters of 2021. As it stands right now, those are the only 2 quarters in 2021 where one can claim the COVID-related retention credits. In order to go into Q3 or 4 of this year, the program would have to be extended. But here's a quick comparison. You're going to see this credit has greatly increased in potential benefit for the first 2 quarters of this year. First of all, as far as the maximum you can obtain on any one employee, we're going from a $5,000 max in 2020 to a $14,000 max in 2021. And that max is going to be 70% of the first $10,000 of eligible wages or healthcare expenses that you pay each employee. And instead of an annual max, that's a max per quarter. So if you max out on one employee on both quarters, you're looking at $14,000 credit on your payroll tax return. The FTE limit that we discussed previously is the same, and as far as the tests, you're still going to look at 2019, but your limit goes up to 500 employees. So if you had under 500 full-time equivalent employees in 2019, you can count all of your wages paid during the eligible period. If you had over 500 full-time equivalents, then you can only count the wages that you paid for people who did not perform services. The revenue decrease trigger has been lessened for 2021, and you get a little bit more flexibility. So instead of a 50% decrease, you're looking for a 20% decrease. And you're still going to use 2019 as your base year for testing that decrease. And you also have the option of using the preceding quarter in order to test for eligibility in the current quarter. So for example, for quarter 1, 2021 retention credits, you're looking for a 20% decline either in the preceding quarter, so Q4 of 2020, as compared to Q4 of 2019, or in the current quarter. So if you have a 20% decrease in Q1 of 2021 as compared to Q1 of 2019, either of those could make you eligible for these credits starting in Q1 of 2021. And you do the same test for Q2. So you'd have to meet the test for both quarters in order to claim the credits in both quarters. If you just meet the test in one quarter, then you're limited to that quarter. And then finally, the option to qualify based off of a full or a partial suspension, that's going to look the same in 2021 as compared to 2020. Some other observations on the 2021 retention credits. Unlike 2020, you can count wage increases for purposes of computing this credit. You still cannot double dip on the credits as far as counting them for loan forgiveness on PPP and retention credits. And you do have the option, if you determine you qualify, to request an advance payment rather than waiting until you file your payroll tax returns. The IRS is currently updating this form. I would recommend that a business that is interested in doing this to wait. I'd really like to see how you're going to be able to coordinate the retention credits with PPP in order to get a good estimate of the credit that you're going to qualify for. If you request too much of an advance here, then it would be due when you file your payroll tax return. If you request too little, then you'd get that back in the form of a refund on your next payroll tax return. So best practices for coordinating the PPP round 2 and 2021 retention credits. Unlike the 2020 issue, we want to look at PPP first here. That's the most time sensitive thing for you to do since you want to get your application in if you qualify. And we recommend that, you do your gross receipts test for PPP2, which should be similar to what you did for retention credits. If you see that you do have that decline, then certainly be prepared to provide the bank with your quarterly P&Ls that illustrate that decline. And then also look at your payroll. Is it going to be more beneficial to you to use 2019 or 2020? If you're using 2019, you might not have to supply the bank with that documentation since you already gave it to them for round 1. But if you're using 2020, then you're going to have to supply documentation to the bank to show your monthly payroll calculation. Some other considerations on PPP2. Yeah, we went over the certifications. Make sure you review those and that you are able to certify the necessity test and that you spent your round 1 loan proceeds on eligible costs. So once you do that, then we can get into the retention credits. So first thing I would do is test for that 20% reduction in Q4. If you do have that met, Q4 of 2020 as compared to Q4 of 2019, then you know you're eligible for these credits at least for the first quarter. And if you're eligible for the credits and PPP2, then we're reasonably certain you're going to get those credits on all wages that you pay prior to you receiving your second round loan funding. Once you do receive that second round loan funding, then you're going to overlap. So then we're going to have to review the IRS regulations to determine how you can best coordinate getting the maximum retention credit you can receive and then also getting your PPP loan forgiveness. And then lastly, keep in mind if you do qualify for either of these programs and you have an expiring benefit, maybe you're only going to be eligible for the retention credits in Q1, or your PPP round 2 loan period is coming due, it may make sense to accelerate some payroll into the first quarter or into the first half of the year just to make sure you're getting the maximum benefit of that program before it expires, likely in the second half of 2021. So that's the overview of these 2 programs that we wanted to go over today. Before we get into the Q&A, I wanted to mention that there's another program in the Appropriations Act that may be particularly applicable to our clients who live in the New Orleans metro area if they were affected by Hurricane Zeta and their business was rendered inoperable for a period of time and they paid their employees during that period of time. You could qualify for an additional credit that would be on your income tax return. We just wanted to put that bug in everyone's ear. If it does apply to you, then please get back to us and we can further discuss that. So with that being said, thanks again to everybody for attending today. I'm interested to get to your questions and we'll go ahead and get to that now. Okay, so first question that I have is it better to apply for PPP-1 loan forgiveness now rather than waiting closer to the deadline? I would say the one holdup that I would have right now in applying for PPP-1 loan forgiveness is if I determine I'm also eligible for the retention credits. And if that's the case, I'm really going to want to wait to, for those IRS regulations before I apply. You're not going to harm yourself by waiting, but you could harm yourself if you apply now and then some guidance is issued later that, really where you had to do something as far as an election goes, and that minimizes your retention credit. Another question that I have is, what if monthly payroll and or FTEs changed? So you're on the payroll front, you can, if they changed in 2020 and it changed for the better, it went up, you can use your 2020 payroll. If your full-time equivalents changed, well, first for retention credits, you're bound by 2019, so a change wouldn't affect. For the purposes of the 300 employee limit on PPP2, my understanding is that you look at your current employee count to see if you qualify. Another question I have, and this is a good one, in regards to the deductibility on retention credits. So for PPP, now that Congress actually changed the laws, we know you can count those expenses as deductions. That is not the case as it exists currently for retention credits. So if you qualify for a retention credit, you're not able to deduct those wages equal to the amount of the credits that you qualify for. As far as to whether or not that's going to change, I haven't heard any rumblings of that. It's an old rule in the tax law that it's defaulting to. It's common with these types of wage credits. So that's not to say Congress won't change that, but in order for that to change, it would take a specific provision in a new stimulus bill that passes Congress. Another question, what does it mean to certify that we have used the PPP-1 loan funds or on eligible expenses? Is this just a statement, or are they asking for documentation? So there's no requirement in the regulations or the bill that you submit any documentation for this certification. It's similar to the necessity test, where you're just certifying in your application that you meet this criteria. The one thing that I don't know is how your lender is going to interpret their requirements on this. That in reviewing the regulations, they're not required to do anything other than check your certification here, not to review any documentation that you have. And my reading of the regulations is that you should not be required to submit your round 1 loan forgiveness as a condition to applying for your round 2 loan. Some other questions here. Does billable expense income count towards gross receipts for PPP2? Okay, so these are expenses you incurred that you turn around and bill your clients. That's my understanding of this question. And the answer is yes. You would count expenses that you incur and then turn around and bill your clients in your gross receipts. Another question here, is the quarterly decrease test based on a calendar quarter or any 3-month quarter? So here you are required to look at a traditional quarter. So a 3-month period, January through March, April through June, etc. you aren't allowed to just pick any 3 months here. So you're looking at your traditional quarters for purposes of doing this test. So that's all the questions that I see right now. Again, if I didn't get to your question, please don't hesitate to email us, info@kl-cpa.com. I'll respond to you most likely today. If not today, I'll respond to you tomorrow. Make sure that we get your question. Thanks again for joining us, and we're happy to work through any issues you may have. Again, we want to make sure that all our clients are getting the maximum benefits that they have available for the retention credits and PPP program, and that you're able to use these to help get you through this pandemic. And hopefully this time next year, this will be a distant memory and we can all get back to business as usual. So thanks again, everybody.